This session is called, I think, Capital Markets and Money Markets, the Shadow Banking System. It's what? No, this is the title of my talk, not the session as a whole. So I'm going to talk. I'm asking everyone to speak for maybe about 15 minutes. So that we have some time for discussion. And because these presentations are sort of related to each other, I think it's probably best if we just sort of run through all three of them and then have discussion afterwards. So for efficiency's sake, and I'm going to go first. So changing hats. I'm Perry Mehrling of INET, and I'm going to talk about shadow banking a little bit. So here's the first slide. What is a bank? So this is the famous diagram that Zoltan Pozsar did at the New York Fed, which he created during the crisis to help the Fed understand what all the different pieces were that needed to be, that were falling apart, basically. And if you look at this, there's a sort of light blue U that's going around there. Those protective arms, that's the Fed. That's the Fed sort of holding in its generous arms the collapsing shadow banking system. You can't do much sort of analytical theory with this, so I have a different diagram, and let me just start with this. I think one of the problems in talking about shadow banking is that people use the word to mean a lot of different things. Some people use it to put the emphasis on shadow, and that sort of anything that's evil is shadow banking. So when I say shadow banking, I mean this, okay? Money market funding of capital market lending. Wherever money market funding of capital market lending is happening, I'm going to call that shadow banking, or capital market-based credit, okay? More to take the shadow out of it. And on whoever's balance sheet it's happening, whether this is happening on the balance sheet of a bank, which sometimes it did on UBS, okay, or whether it's happening in an SPV, which it did for Citibank, or whether it's happening wherever, okay. This is the phenomenon that I think we need to be understanding wherever it's happening in the world. Money market funding of capital market lending. And here is a mental picture of what I have in mind. This is not what the shadow banking system looked like exactly. You probably know there are all these tranches and CDOs and all kinds of weird stuff. But this is my image in my mind of sort of the economics of it, what it was trying to do, and maybe what its future might be if it has a future. So what I'm showing here is on the left-hand side there, the thing that I'm calling capital funding bank, you can call a shadow bank if you want to, but you notice that this thing is doing capital market lending with money market funding. RMBS is residential mortgage-backed securities, okay, and so that's capital market lending, and money market funding is on the liability side. And what I'm showing with those different CDS, IRS, FXS, those are swaps. So it's swapping out all of these exposures. So credit default swaps, interest rate swaps, foreign exchange swaps, just think, because I'm thinking of this as a global system, not just a dollar system. So that it winds up with an asset side that is as nearly risk-free as possible. And for analytical purposes, we will say it is risk-free, okay, that somehow these derivatives are there that allow you to swap all that out. And their counterpart is this asset manager I'm showing on the far right-hand side, which is a modern pension fund manager which gets all of its risk exposure in the derivatives market. And so I'm booking those as liabilities just for consistency with here, whereas a hedge is an asset, an exposure is a liability here. So you have this asset manager having long-only capital there and getting all of its exposure in the CDS market, the interest rate swap market, the FX swap market. And it's holding deposits or some kind of perhaps term money market instrument there, which it uses as collateral to cover its swap positions there. And so you can see those are just mirror image balance sheets, right? The asset manager and the shadow bank. But standing in between them are these two kind of dealers. A money dealer, which is the global bank there, which is collecting deposits from all over the world from anybody and then lending them on somewhere at a spread. and you have the derivative dealers, a risk dealer in general, which is collecting risk exposures and then matching them on the other side. Both of these dealers in this model are matched book dealers, so and perfect matched book dealers. So they have no capital because they don't need any capital. Okay, that's obviously an abstraction. They have the same risk exposure on both sides. And similarly, the capital funding bank has no capital because they don't need any capital. They have risk-free asset on the left-hand side, and they have a risk-free asset on. All the capital is on the balance sheet of the asset manager. And that's where all the losses take place. The liquidity dimension of this is sort of hidden, but it's because of these dealers. These dealers are the ones that are making the liquid markets, and as long as they're rolling the funding, okay, as long as the global bank is rolling the funding, and as long as the derivative dealer is not stopping you out from your derivative position, okay, you're okay here. Now, so this is a stylized model of what shadow banking is. Money market funding of capital market lending. So the last thing I'll say about this is when you're talking about that, you're talking about prices. Prices on both the asset side and the liability side, okay? That as opposed to normal banking, where this is sort of you're dealing with a relationship or you're dealing with something where the prices are opaque. Here, these are market prices, okay? These are the price of residential mortgage-backed securities is determined in these risk markets here. Okay, and the price of funding is determined in these funding markets here. Both of these are global markets. Both of these are transparent. But I'm assuming here you see these. Okay, these are capital markets. Okay, so that's that. That's the main talk, okay? Everything else is footnotes, okay? So here's some key elements. So I wanted to emphasize that these are global funding markets being driven by the cash pools and intermediation chains. That's one thing to say there, that from the asset manager there. These are global markets, market pricing, I mentioned that, matched book, I mentioned that. This is an idealization, and here's the things that I'm abstracting from that I know are true, okay, and that are important, and one could add to this model. I don't mean that, I think of these as complementary, not substitutes. So if you were to relax some of these assumptions, some of these entities are going to want to have liquidity reserves of T-bills or cash. If you relax, there might be capital somewhere else other than on the asset manager because they might be facing some capital risk if you can't have perfect matched book. I don't have any retail deposits here anywhere. I don't have any investors who are holding outright security. I have everyone doing it through the derivatives markets. You could add those. The point is that this is the marginal market where the prices are getting determined and where the crises are getting determined. This is the part that collapsed in the crisis. So it's the part we need to understand. I'm also abstracting here, and this is a more serious one, but in my most recent work, we've relaxed this. Proprietary dealing, the dealers are matched book dealers here, and when you're talking about growth and shrinkage of the system, you're talking about dealers who are going to wind up having inventories and therefore having price risk, and that adds, and you're going to be pushing prices away from their fundamentals. This is important for understanding the growth and collapse of the system. Unfortunately, I'm not going to be able to get into this too much today. Maybe in Q&A, and there is a paper which does talk about that. The reason I'm not talking about that is because I want to really emphasize the liquidity backstop piece. Okay, the central banking in both the funding liquidity and market liquidity. And so what I'm showing in this next slide is the two dealers that I talked about, the global bank, and which I'm just reproducing their balance sheets here, and the derivative dealer here. But I'm adding now in red as an asset a liquidity put, funding put, and a market liquidity put, and I'm putting as a liability of the central bank or of the group of central banks this liquidity put, which is implicit, I think, just in the nature of the system, that if there's a crisis, the central bank is going to be called upon to do this, and it is going to do this, provide some liquidity. And so I urge, let's put this on the balance sheet, let's make this explicit, let's think about the public policy consequences, let's think about how we want to price this. And so this is sort of the completion. This is the fifth balance sheet, the central bank balance sheet, that completes that system, that is holding it up when it runs into trouble. I don't think the central bank necessarily should be backstopping proprietary dealerships at all. My matched book ones are Volcker dealers, okay, and so that's why I'm abstracting from proprietary trading for the moment. So this is the experience that has led to this talk, right? This is the balance sheet of the Fed. This shows you the assets on the up there as positive numbers and liabilities as negative numbers, the vertical lines are Bear Stearns and Lehman Brothers there. This is what happened when the shadow banking system collapsed. The shadow banking system collapsed onto the traditional banking system, onto the balance sheet of Citibank and so forth, which thought they were going to be able to hold it, and then they couldn't. And then it basically collapsed onto the balance sheet of the Fed. That's an oversimplification, but it's also sort of truth. So, and what you're seeing there is an escalation of the intervention of the Fed before where you see the dark blue only. This is what the Fed looked like before the crisis. All treasury bills on one side, all cash on the other side, basically. Tiny bit of bank reserves. It was easy. It was an $800 billion balance sheet, and there was one asset and one liability. And the first thing the Fed did in the crisis was lower interest rates from 5 to 2%, and it basically did nothing. Okay. Then after Bear, they liquidated half of their treasury bills and lent them to broker-dealers, and that stabilized for a while, but not that wasn't the end of it. And then after Lehman and the turndown of TARP, the Fed tripled its balance sheet in 2 or 3 weeks. And that is still there with us. Why did that work? This is the balance sheet of the Fed as of December 15th, 2011. Okay? And so it's not a simple little balance sheet anymore with $800 billion worth of treasury bills and $800 billion worth of cash. You have 1.7 of treasuries, mostly long-term treasuries. You have some mortgage-backed securities, almost $1 trillion worth of those, and some other. We still have that $1 trillion worth of currency, but now $1.6 trillion worth of excess reserves. Now, I do a little trick there in moving to the restated balance sheet. And now I'm going to have to walk away from this mic. And maybe I should take the mobile mic. Because they don't have audio mics. Can you turn on the mobile mic? How do I turn it on? I guess just like that. Oh, it is on. It is on. Good. So just to show you how I did this, risky securities, so that's this mortgage-backed securities there. I'm just adding $0.9 trillion worth of treasury bonds on the right-hand side and adding them on the left-hand side too. So 1.7 plus 0.9 is 2.6. Then I'm adding 2.6 trillion of treasury bonds on the treasury bills, short-term stuff, on the right-hand side, and the same on the left-hand side. And then I'm also just summing reserves and currency and calling it one line there, 2.6 trillion. So I haven't actually done anything except add and subtract from both sides at the same time. And I've done that to show you that this third line, if you're long risky securities and short a treasury bond, what is that? That's like a credit default swap. Okay? If you're long treasury bond and you're short treasury bills, what is that? That's like an interest rate swap. If you're long a treasury bill and you're short overnight, okay, that's like an overnight index swap. Okay? So what I'm showing you is that the balance sheet of the Fed, as a consequence of this crisis, okay, looks like that. Looks like that. Okay? The Fed has in fact acted as the dealer of last resort in the kind of system that I'm talking about. You can't see it because it's not allowed to hold swaps. Okay? This is what it's allowed to hold, but the exposures are exactly the exposures that you would expect to see. So I think that this is not a one-time thing. Okay? This is a symptom of the idea that this is the brave new world that we are living in. 2 more minutes, and I call this a Badget Moment. This is my book on the right. This is a much more famous person than me, Walter Badget, on the left, where writing in 1873, saying, what is the logic of all of these financial crises? What does the Bank of England need to do in the future? They need to lend freely at a high interest rate against good security. And I think we're in a similar position now with this market-based credit system where we need to re-examine from the beginning what it is the role of the central bank. And the first thing to do is to think about what to do in crises, which I'll come to in a minute. I'm just showing you here, no, I'll switch to this one now, I guess. There we go. So I'm showing you here a numerical example of my little 4 balance sheet thing with the capital funding bank, the global money dealer, the asset manager, and the derivative dealer there. And thinking of these as numbers, okay, that there's $100 worth of capital in the system, and there's $100 worth of RMBS in the system, and so I'm just tracing that through. And at inception, all of these swap positions are 0. But what happens if the value of these RMBSs fall by 10? The thing that happens immediately, okay, is that if everything works smoothly, okay, the associated CDS should go up by 10, okay, so, but the problem that could happen here is a funding problem for the capital funding bank, that if they can only pledge that RMBS, they can only borrow 90 against it. So they need to be able to somehow get collateral from the CDS in order to roll over their funding from the money market funds. And so does the global money dealer. They need to secure their deposits to the asset manager. So there's a collateral issue in the short run. This is a lot of, I think, what we're going to hear about collateral rehypothecation and flows and things like that. The notion that fluctuations in value, if you have to top up margins and things like that, this can cause liquidity crises, okay, in a system like this. Now I'm showing you the permanent. So now suppose this is a permanent fluctuation in value, that we realize these mortgage-backed securities are in fact not worth 100, they're worth 90. So what you need to have is a system where you're transferring $10 worth of money, okay, from the asset manager to the derivative dealer. Okay. This goes to here, which goes to here, which goes to there, which pays off that, which pays off that, so that it all clears out. This is a lot of flows. There's a lot of flows that have to work without a hitch, okay, in order to make these valuations work. They did not go without a hitch, okay? That's the point, okay, in this crisis. There was a fluctuation in value, and it basically jammed up almost immediately, okay? And as a consequence, people who couldn't roll their funding had to liquidate their stuff, and you had all kinds of problems. So this is an image to have in your mind as we're thinking about regulation. Because what I am trying to put this forward is as a sort of roadmap. Zoltan had a roadmap of what shadow banking used to look like. I have a roadmap of what shadow banking might look like, and therefore how we might think about the regulatory system. I'm thinking about the world as if it was only shadow banking, and that's what this is. This is a world that's only shadow banking. And I think the question on the table that I'd like to leave you with is how to regulate it. I think we did learn in this crisis what to do in a crisis, and these are the 3 rules of crisis. But everything else is up for grabs. Prudential regulation, macro stabilization. So lending to markets, not to banks, outside spread, not inside spread, core, not periphery. These are the 3. This is this paper that I published in April in the American Economics Association, which you can read. But just to connect that up here. So that's me, and I've run a tiny bit over time showing bad form. And Torvald, you're next. Let me just pull you up your thing here, just as by way of apology. Okay, this is you here. Okay.
Thank you. Thank you so much for inviting me. I'm from the Central Bank of Norway, and therefore I should say that whatever I say is my responsibility and not that of the bank. I think this session has been sort of announced as the shadow banking system, but as Perry has alluded to, it's as much about what central banks should do in a crisis. And what I would like to discuss with you is some of the work I did while I was at Lavoie as a visiting scholar last year, and give you a practical practical perspective rather, since I'm not an academic. I'm a practitioner, and I'm currently back in the central bank working on financial regulation, including some of the shadow banking stuff. What I'll do, I'll talk a little bit about what actually shadow banking is, a little bit about endogenous money. Liquidity illusion, which I think is key here. We'll come back to that in the Q&A in terms of who should support the prices and the role of the central bank in this new world. And then I'll just touch upon the regulatory reforms, because there is actually a host of new suggestions coming up from among others the Financial Stability Board this month. And then finally, I'll conclude with what should central banks do. So I think we'll also get a good discussion going here afterwards. Just a little bit of public relation here. This is a working paper that I started out doing at Levy when I came there last year. And just to give you a little bit of background, before, one thing, I was fortunate to go there, and I spent much of the fall reading about Minsky and what he actually meant about, lender last resort, what the central bank should do in the crisis. One of the things I sort of, and I should also say that my background was very practical in having worked on, crisis preparedness, lender loss policy in the central bank, and in terms of collateral policy, what we should take or not take, and so forth. And then one of the questions I had, which ties very neatly in with this other story here, was, in a situation that actually the Fed was confronted with, is that something we want to repeat? Is that something that was, what you would have done if you were prepared, or, was it really something that was done out of, the urgency of the situation, and that's something we rather should not repeat? And that was actually the basis for this paper, which touches upon, both the lender last resort policy, the development of shadow banking, and collateral policies, which I think are the three key issues on the table here today. In April, or actually in January, when I presented the paper the first time, and later on in a revised version, these were my conclusions, just to give you, where I came from. In this paper, the question, as I said, was the following: should central banks provide unlimited liquidity support to banks or financial institutions in a crisis? And my view sort of was intuitively no. I mean, there needs to be a balance somehow between what the central banks should support and what that system do. And if they get off the rail and if they do all sort of crazy things, they shouldn't necessarily be we shouldn't necessarily be underwriting that. And and as I'll come back and when I discuss Minsky, I think he also was pretty clear that you need regulations ex ante in order to limit the potential need for support. And all of this is related to too big to fail policies and all that stuff. But I don't want to go into that today. But it's sort of in the back. Okay. It's really funny how much things change during a year, and trying to keep up with what's been coming of different reports is really hard. This is just a sort of a description of the feeling I have being working in a central bank, and trying to react to every new paper or speech or whatever comes along. And it's really been an avalanche of new papers, and if you try to go outside of your main area, for example, there is a host of reforms on OTC and swaps and derivatives, in addition to capital requirements and liquidity requirements, and everything is, as you said, up for grabs. So this is, both exciting times, but it's also pretty strenuous times if you try to keep up. Obviously, the New York Fed people have done, a tremendous job on pulling these things together, and they have been in the forefront together with people in the IMF on trying to understand what's going on in this new shadow banking system. The official response, to this has, in addition to the Basel proposal, been an intensive amount of work in the Financial Stability Board, delegated to the Basel Committee, IOSCO, and some of the other regulatory fora. And I'm just mentioning these, the first one goes on consolidation rules. The other one is the famous money market discussion where there has been, new guidelines by IOSCO. The other one is, discussing other shadow banking entities, securitization, obviously, and this very important area of securities lending and repos where, there has been also new suggestions coming out both from the EU Commission and from ESMA, the European regulator. Well, as a step back here, because I think we need to sort of discuss what are we discussing. I mean, shadow banking is in a sense a new term for something which has been around for a long time, and I think maybe it's wise, as Perry alluded to, that we should try to stay away from the term altogether and figure out what are we actually looking at. The FSB has this official definition. The shadow banking can broadly be described as credit intermediation involving entities and activities outside the regular banking system. But it's surprising when you look at papers, trying to pinpoint and describe how large the shadow banking system is, that there is, as many suggestions almost as there are papers on this. And I think that's a problem, and there is really a job to be done to figure out, is this a useful concept, and if so, how should it be measured? And I think we had, some discussion the other day where you said you might have a definition of shadow money, perhaps, rather than shadow banking, or, there could be various other ways of doing it. But as I say, there is no agreed way to measure this. Should it be whatever is non-regulated or, illegal, or just out of view or in the shadows? There might be things that actually are registered, but, it's just not counted as part of it. This is just to sort of show the irony of the thing, in the sense that this is one of the I think a graph from Singh's paper in IMF, but it actually shows the growth of the traditional banking sector and the shadow banking sector, and the fact that after the crisis the shadow banking sector has sort of almost collapsed back to where it was some years ago. And then you can say it's ironic that we now spend so much time on discussing the shadow banking system when it may be dying on its root. It's clearly under pressure, and the question is whether it will be revived. But there is clearly a concern amongst policymakers that by putting tight regulation in banking, you might have this all transaction emerging again outside the borders of regulation. Again, in terms of how to measure it, it is, the traditional way to measure it is by assets in the different institutions. So you decide which institution should be in, the shadow sector, and then you sort of add their balance sheets together. And that's not a very good way of actually getting to it. This is just to show an interesting example from a working paper from Bank of Ireland, where they actually, have taken the activities of each, financial vehicle corporation, money market funds, equity funds, bond funds, the sectors that are traditionally counted as shadow banking sectors, and then they look at how much of these shadow banking activities are actually present in each of these institutions. And I find that, a promising way of actually getting a real discussion of what matters. But then, interestingly enough, you can perhaps say that securities lending is an important part of connecting you with the shadow banking system, and then you find that regulated traditional, for example, insurance companies do securities lending, and does that mean that they should be counted in the shadow banking system? They're not a bank, but still. So this is not settled, and I think we need to have more discussion about that. I just wanted to say that, in my mind, shadow banking is sort of strange, because it's really a phenomenon which has been around for a long time. And somebody, and my favorite quote here is from Thornton, it's 1802 book, where he actually alludes to the same phenomena and says that, you have a boom and everybody suddenly gets excited, and, you have the development of near money, and people accept liability or assets, or they accept, they start accepting credit and give loans on basis that they would otherwise not do. So, it's nothing new in that sense. The interesting thing, in my view, and this, is a broader issue in terms of, whether we are gaining sort of acceptance for endogenous money view in the mainstream, is that, in a sense, there is an opening among key policymakers these days, and they are speaking a language which is sort of more along the sort of, endogenous money view, if you wish. And this is from an ECB official, but I think it very nicely captures this process whereby money is created and then destroyed during the cycle, and they really, I think it's a promising sign that you could, open up for some agreement here on what's going on. Haldane has been out making a lot of speeches, and he's talking here about cycles in money and banking are familiar from centuries past, and that neglecting some of this has made us very vulnerable to misconceptions about what went on. And again, Tarullo from Federal Reserve, I think, is spot on when he's saying that we really don't, or at least that he admits that they really don't understand this idea of private money creation, and it's something which has fundamental consequences for central banking, and so it's something that we need to clearly address. Okay, so how should central banks respond? I put up my position in the beginning, and I still feel that we need to be somewhat skeptical of accepting this new brave world unconditionally. And that's why I think the discussion here might go along the lines like, is dealer banking system something that will, be there and that, is okay, or should it be restructured, or can it be restructured somehow so that the job for the central bank in another crisis becomes less strenuous. Something which hasn't been mentioned is that, in fact, the legal system as it is now drawn up in the US has put in severe limitations on what you can do, but you could say that that is a traditional problem of time inconsistency here, that, in fact, when there is a new crisis, they would have to do what they have to do. But legally speaking, I mean, there are huge constraints here, and in addition, there are the obvious fiscal constraints of what the state can do in terms of underwriting a financial sector or a financial system. So, I mean, my basic sort of concern is that one part of the system has gotten so way out of line with the capacity or the willingness of the official system to support it that we need to redo the architecture in a sense. This is just a visualization of the same point. I mean, you have this huge growth in financial sector assets, and my question is, I mean, can we put the genie back in the bottle? I mean, it's really a question of, whether the system has gotten, way out of line with where it should be, and which is, as you all know, the basis for the current discussion of Volcker, Vickers, Likan, and all these reform proposals. But I have to admit that, after having looked at some of the proposals which is currently coming on stream from Basel, from FSB, and so forth, and many of these are not quite there yet. You could wonder if this is going to be, self-constrained, and actually that it will be less than it would otherwise have been. Well, this was just to connect to Per Mehrling's new Badget rule. Banking is dealing, central bank is liquidity insurer. Large markets require large insurance, insure freely at a high premium, make the implicit liquidity put explicit, and argue about the details later. But to me, in my mind, I mean, the detail here, the question of the price. I mean, the price of the liquidity insurance is the critical one, and I think, frankly, that many of the markets have operated on funding liquidity assumption that are unrealistic, and therefore my term liquidity illusion, in the sense that markets have somehow automatically assumed that the central bank would step in. But I think that assumption has been wrong, and it has been at least severely underpriced. So my summary would be that I think you have this sort of money-making system, in a sense, endogenous money system, which is growing without control. Central banks should not backstop the system unconditionally. Liquidity support should be conditional on structural reforms, and deficit financing, as Minsky would say, would be an essential complement as private sector delever, and as Co was just mentioning. And the global financial crisis provides a window of opportunity for new theoretical paradigm of banking. I mean, again, I've written more about this in my paper, and this is the well-known sort of Minsky theory. But I do think, looking at what comes out of official speeches from BIS, from Bank of England, from Andy Haldane, or whoever, I mean, there is a good opportunity to have, a connect with policymakers in terms of what would be, really, good policies in tackling this. And so the challenge ahead would be to control and guide the evolution of finance. And this is, again, a quote from Minsky. Thank you.
Okay, that's good enough. So I would like to talk about. Okay, fine. Where is? Just click down there. Yeah. Right there. I see it. I see it right here. It's right here.
That one. Yep.
There we go. I would like to talk about some of the macroeconomic implications of what Perry described in particular, because sitting from inside the financial system and I think having a pretty good view on what a lot of important actors are actually doing, I think Perry's representation is almost exactly right for a huge part of the system. Obviously, it ignores some things, but I think it's critical, and I think it allows us to have a critical narrative on what's happened over the last few years, and of course to have a discussion of what happens next. So this idea of endogenous money, and I'm sure I'll get accused by someone of conflating the difference between money and credit, but from a practical sense, from a banker's perspective, from a banking school perspective, I think there's a continuum of moneyness that exists across all assets, and bank reserves are the most moneyest, the most have the most moneyness of all things, perfect moneyness. I think of moneyness as basically zero duration risk, zero liquidity risk, and zero credit risk. And I think investors, when they choose to hold an amount of liquidity, or a household when he chooses to hold money or liquidity, and again, you're going to hear me go freely between safe, liquid, money-like assets and cash. I think when investors choose how much money, as is conventionally called, and safe, liquid, money-like debt or other assets, I think when they're choosing that, they're thinking about what their target safe asset portfolio is, and at times a perception arises that lots of non-money assets effectively are money, and whether it is money or not is nomenclature to me. It's not that important. But the macroeconomic implications of that are huge, and this is a story which has gone on as long as there have been business cycles. You can think of, you could think of the Bank of France in 1715 and the Mississippi bubble, and tell a very similar story. But I like to think about this in a microeconomic sense first, in terms of the demand for money. So the demand for money is almost always measured, as you know, as just basically a function of interest rates. And growth or transactions or expected transactions, and I think there's a third factor which is pretty obvious if we're defining money narrowly, and that is the funding liquidity of the other assets that someone owns. So if you're just a regular homeowner and you've always tried to keep a bank balance, which is say a year's salary in the bank. So your money demand is basically equal to your annual income. And then one day your bank calls you up and offers you a home equity line of credit as a product. You pay $200, and now at a 4% interest rate you can borrow cash whenever you want against your house. You may not actually borrow a penny, but the fact that the funding liquidity of your house is now better means that you're very likely not to hold 12 months of salary in the bank anymore. You're going to use that cash to go and do other things. And this phenomenon, of course, is at work really across all types of economic agents, and especially in the financial system itself, where you have people in Perry's world with the ability to take on large leveraged positions. And if you think of a high yield fund, So I'm an asset manager with $100 million of junk bonds, and it's 1996. And I can't post those junk bonds as collateral and borrow against them because there's no repo market for high-yield bonds back then. And high yield is very illiquid, and when times get tough and spreads widen, the bid-ask on these bonds widens so much sometimes they don't even trade. So I'm probably maybe 70% in high yield and 30% in cash and T-bills. But then 10 years later, it's 2006. And now not only is there a repo market for high yield bonds, but the haircut on high yield bonds for some people is as low as 5%, which means you can borrow up to 95 cents on the dollar against a high yield bond. So what does that mean in terms of the cash balance that high yield investor is going to hold? It's very likely, first his balance sheet is likely to expand, but also, even if it didn't expand, he's not going to be 70% in bonds and 30% in cash. He might be 95% in bonds and 5% in cash. And in my view, the improvement in liquidity that we had in the 10 years until 2007, for a variety of reasons, but especially because of perceptions of underlying credit quality and where the economy was going, and certainly some erroneous perceptions on things like defaults on mortgage securities, led to this situation of falling haircuts, rising prices, and ever higher leverage. But what was really happening was that people were getting a sense that they had much more liquidity and much more effectively money than they really did. And that, of course, had disastrous implications later. So what I went and did was I actually tried to quantify this. So I moved to New York in 2007, and I've been looking at this kind of stuff for a while, but I happened to land next to a repo desk on a trading floor. And I was very interested in these haircuts, and I had sort of this idea already. I was very familiar with Nobu Kiyotaki's work, and that kind of set the wheels moving. And so I started to measure these things. And in early 2009, when I'm going around and doing client meetings and just normal macroeconomic strategy, there are basically two views that shrill hedge fund managers had. The first was because of a significant rapid decline in private sector debt, we're headed for debt deflation, we're headed for deflation. The other view was because of significant increase in central bank activity and possibly reserve balances and publicly provided liquidity and government debt, that we're headed for runaway inflation, so you have to buy gold. And it struck me as kind of nuts that the view was either strong inflation or strong deflation. And I said, well, what if actually the system has within it embedded forces that actually can make this a little more even than we think, and those forces go a lot beyond just a simple decline in interest rates. So what I did to measure it was I relied on the logic that I described earlier in thinking about the high yield fund manager and the household. I think if you have a bond in your left pocket worth $100, and you think you have someone following you around that's going to give you $90 if you post that bond to him as collateral, then your whole portfolio, what's in your right pocket, is going to be constructed as though you already have about $90 in cash. So I call that bond shadow money, and I have no interest in getting to an argument on nomenclature of whether or not that is money, but I think it certainly impacts the guy's behavior. So what I did, and having an advantage of being able to get lots of data, I got haircut data for every type of debt in the US. And I got the market value of each type of debt in the US, and I basically made the same calculation. If you have a bond worth $100, 10% haircut, it's $90 of shadow money. And I separated it into the public stuff and the private stuff. So the private stuff is investment grade corporate bonds, high yield corporate bonds, commercial mortgage-backed securities, non-agency residential mortgage-backed securities, and other forms of asset-backed security. And on the public side, I'm looking at basically treasuries, agencies, and agency mortgages. And these are the totals. And yes, on the private side, that's a decline from around $9 trillion in late 2007 to just over $6 trillion in 2008. And just for historical trivia purposes, that's about the same percentage decline of the M2 money supply between 1929 and 1933. So that, to me, is a gigantic deflationary shock, precisely because this immediate loss of perceived liquidity means that everyone wants to hold a lot more safe, liquid, money-like stuff, however they can get their hands on it. And fortunately, there was a means of creating safe, liquid, money-like stuff at the same time, and that was deficits, of course. So private shadow money is falling because the valuation of the debt is falling, because the net issuance of the debt is negative, and because the haircuts on the debt are picking up very substantially. And after a couple of years, of course, that has come back, but you'll notice there's been no growth in that ever since we've adjusted. The adjustment is haircuts going back to normal for the most part. But private shadow money goes from 9 trillion to 6 trillion, back to 9, then doesn't grow, and has been contracting recently, which interestingly is mostly driven now by a net decline in financial corporate debt. Other forms of debt are relatively stable, although everywhere we hear that this big deleveraging is going on. It's not quite in the data, but it's in a lot of people's views. But you see public shadow money up and away from 13 trillion to 20 trillion.
Is that Treasury debt that you're saying?
Treasury agency and agency mortgages combined. So I think this is illustrating the creation of new, safe money-like stuff for people to hold when their demand for it has gone up very substantially. And I've looked at various ways of measuring it. One way is we can take the M2 money supply and we can carve that into public and private. So M2 minus the monetary base is inside money, and the monetary base is outside money. So I kind of look at an overall aggregate. It's roughly the same story. But then we can more broadly look at different monetary aggregates. Monetary base, M2. On the left-hand side of the chart, some very big numbers. As you go to the right, you see shadow money growing less over 5 years, effective money growing even less, and then effective money plus rehypothecation, which is the broadest measure of money and liquidity that I can come up with, growing only 14% over this period, only a little bit above nominal GDP in a period where, without a doubt, the demand for money and for liquidity and safety has just soared. So what about this rehypothecation stuff? There's a lot of talk about it. Very few people actually know anything they're talking about when it comes to this stuff. So rehypothecation is not the repo market. It's not the churning of bond collateral when people post collateral for derivatives trades or things like that. The reason it's not that stuff is because those things exist on dealer balance sheets and are captured in the flow of funds. Manmohan Singh's work focuses on rehypothecated securities, which are mostly equities and are mostly hedge fund, long-short hedge funds having relationships with dealers, prime brokerage relationships, where they basically post all their securities as collateral to the dealer, and then the dealer uses that collateral. And what does the dealer use it for? Well, the dealer uses the collateral to make markets in the equity. So dealer has customer equity, dealer makes very narrow bid-ask spread in a given market, and I think that's a good thing for the market as a whole. If the dealer can also use that to actually lend it to a securities lender in exchange for something else, ultimately potentially use it as a source of funding, and that's the bad part of it, and that's the scary part, which needs to be measured, needs to be tracked. Is it in the flow of funds? But my point is, when you look at this system of rehypothecation, it's what really gives rise, this movement of collateral, equities and bonds, to the sort of liquidity that underpins Perry's stylized version of how the system works overall. And we have still a very significant amount of liquidity in the financial markets, which this system over 25 years has built up. And as we now attempt to regulate that system, we do cause headwinds to arise in the near term at a time where we might not desire all those headwinds. And in particular, when I talk to regulators about specific rules on collateral and this sort of stuff, what I say is, look, each individual rule seems to make sense. I understand why that makes sense, why that's prudent, why that is possibly reducing bad behavior somewhere. But the problem is that what they're generally doing, the sum of all these rules, is having the effect of limiting the supply of safe, liquid, money-like collateral by reducing the financial system's capacity to generate it and increasing the demand of the same stuff. It's basically forcing people to go out and either run bigger financial surpluses or hoard more government debt and more cash at the cost of making liquidity less available to private markets, which is something we see very significantly. And on the rehypothecation numbers, basically the red lines is the amount of collateral received from customers, blue line is the total amount on all dealer balance sheets once you account for all the churn, and the amount is down and the churn is down too. So I'll leave you with one, I think, potentially interesting macroeconomic suggestion from this is I think what we've done today is we've described the system, and we're not really saying whether it's good or bad or making comments on specific regulations, but it is the system, and we are starting to mess with it in ways that hurt a little bit. But I'd just like to think a little bit about how this system came to be. And, you know, for all this talk about debt, this is non-financial debt in the US. So this is the household debt to GDP ratio in blue and the non-financial business debt to GDP ratio in gray. And what you see from 1980 to 2000, they have very mild uptrends. They're not really that troubling. The view in the world seems to be that our debt has been growing out of control for a long time, but didn't really happen. Then we had a clear and obvious bubble and problem situation from 2001 to 2007, which is now being reversed. Okay, I understand that. But what's happening on a secular basis? This chart looks at other parts of aggregate debt. The red line is financial debt to GDP, and the green line is federal debt to GDP. And you'll notice that financial debt to GDP has been trending up at even a roughly constant pace the whole period from 1980 to 2007. When it was reversed and the financial system delevered during the crisis, you know, interestingly, the government debt went up by a very similar amount over a very similar time period. If you add the two up, they're on the same trend. That's kind of silly, I know. There's no reason for that to work. The financial debt doesn't include things like rehypothecation. It's an imperfect measure anyway. But the point is that there seems to be an underlying macroeconomic force here that's been pushing financial debt up for a long time, and maybe that's related to the same macroeconomic force which has required this injection of additional safe, liquid, money-like collateral. What is that force? In my view, it's globalization and deregulation. And on the globalization side, it's as we globalize trade and as we have a high productivity world, we require lots and lots of liquidity. And in my view, the financial system has evolved effectively into Perry's diagram in order to find ways to accommodate that liquidity. Because if you can take a bond and you can strip out various risks and make it much more liquid, you're giving people liquidity. You have a much more flexible system which is adapting and evolving according to basically what the economy wants. If you get in the way of that, I think you're going to be left with fiscal and monetary agents, which much more responsibility and a much more difficult challenge in maintaining any kind of steady nominal environment. So I will stop there.
So that's it. Now it's your turn. Jan? Oh, I need to give you the mic here.
Okay.
Just introduce yourself.
Yeah, my name is Jan Toporovsky from the University of London. The whole discussion of shadow banking is inevitably complex because, as I think all the speakers have admitted, people have different definitions of it. I mean, we're used to the idea of shadow banking really as a subsidiary of the banking system, i.e. that bit of the banking system which the banks keep off the balance sheet. And this, to some extent, comes out in Perry's and in Torvald's presentation. But there's also the idea, which I think Perry hinted at, of shadow banking as a subsidiary of institutional investors. These are the asset managers. I think one of the key things which came out was important in the crisis. was shadow banking as a subsidiary of non-financial corporations, either because they were non-financial corporations that were overcapitalized, had excess capital which they kept in liquid assets, or situations like GEC Capital, for example, which was subsidiary of GEC, financed, but doing the operation that Perry was talking about of financing itself from the money market for financial operations. So I think I would want your views on, this going a little bit beyond the financial system as being the source of shadow banking, but into the non-financial corporate sector. And then on James Sweeney's very interesting paper, I thought I was intrigued by the measurement of the collateral value of various bonds. I did some work recently, and I found that what was very surprising was the nominal amount of government debt held by U.S. depository institutions in 2006 was, in nominal terms, it was the same as it was in the early 80s. It was an extraordinary conclusion, and I do wonder whether some of these collateral value changes has not been actually in effect a kind of relative draining out of government bonds from the U.S. banking system, and whether that didn't contribute to the crisis.
I think maybe it'd be a good idea to get a bunch of comments since we've been talking for a while, and then we can wrap up. I'll pass it along. I saw Mark here.
Yes, thank you. I'm Mark Lavoie from the University of Ottawa. It's a question for all three of you. I was wondering if we had a sudden change in the financial system where shadow banking would be outlawed, so there would be no repos, no securities lending, no securitization. What difference would it make to our real economy?
So I really appreciate the fact that I think all three of you talked about law and finance, and I will talk a little bit more about this tonight, but let me just ask some questions to tease out some issues. So I think, Perry, you were talking about sort of the valuation of assets on these balance sheets, and I was wondering what differences different accounting regimes make in that regard, because these assets are priced in markets, but what prices make it onto the balance sheet is ultimately an accounting rule question, and so mark-to-market, of course, has been big in the debates, and I was wondering what you think about this. Regarding sort of the second question paper, I was sort of intrigued by sort of this tension. On the one hand, we want to go with Minsky and his ideas and restructure the financial system, right, which is politically difficult, but maybe we should really do this to reduce the chances of it destabilizing endogenously again. And on the other hand, we resist at the same time the rigidities imposed on the central banks. And I think I agree with you that if we want to do this, we have to do it both at the same time. So my worry right now is that for some political reasons, we have constrained the central bank, but we haven't constrained sort of the financial system. And if you then basically make it too rigid for the central bank to respond, we probably have to blow up the system before we can rethink again. And then on the final paper, I can see the argument why we want to have the private sector develop sort of these new safe modes of money, but they do this on the back of legally credible, enforceable instruments. But if the future changes, as it will under fundamental uncertainty issues, at some point we have to relax it a little bit. We have to give it a little bit of slack. So I'm a little bit doubtful about the private sector to create this really safe things for, again, individual firms, but the entire argument for you also, I think, is to look at the aggregate level.
Maybe that's enough for now. Let's have some response, maybe in reverse order. You want to go first, James?
Okay. All right, well, if I could remember all the questions.
I can remind you.
The first question was about non-financial non-financial shadow banking. I do see a lot of this. Recently, someone told me about one of the larger global luxury automobile manufacturers who were, all these companies can fund themselves very, very cheaply in the open markets at the moment. But what are they doing with that cheap funding? In the case of this company, they were making consumer loans in South Africa. And this is a company far from South Africa. But basically, they are holding, they're effectively holding asset-backed securities of consumer loans in South Africa and funding them with in the money markets.
But they're a shadow bank.
They're a shadow bank, but they're an internal shadow bank within a global manufacturing company. In my view, and I tried to hint at this at the end, you cannot separate the financial globalization. Financial globalization and the development of shadow banking, to me, are the same process, and they are deeply related to and intertwined with the globalization of trade. And if you talk to corporate treasurers and how they think about their balances, how they employ liquidity, and how they access liquidity globally, it's all very much related to this system. No one really relies on bank loans anymore. Is the point. And actually, there's an interesting story where I've been focusing a lot on the outlook for construction spending in the U.S. and I recently spoke to some executives from some of the large builders. So the home building sector in the U.S. has been outperforming everyone for the last 2 years as the housing recovery starts. And they were saying how they used to be a pretty small share of the construction market, and their market share is zooming higher. And the reason is they can sell convertible bonds to the market, and everyone else. The construction companies they're bidding against when they try to buy land in some city to develop a project have to post land as collateral and borrow from a bank, and they can't do it. So there's a huge profit opportunity for those companies. And this plays into the other question about what would happen if we got rid of shadow banking now. Like, to me, companies believe that they're, the potential activities open to them are there because they have this menu of funding options. Their production possibilities, as they look across, their global opportunities, are only possible if they have the most substantial global funding options, and I think this system actually provides this for them. The problem ultimately is as you move towards securitization of anything and away from relationship banking, you rely more on liquidity rather than immediacy and personal knowledge between lender and borrower, which increases the possibilities of production, but also raises risks because people may not, the German Landesbank may not quite understand that which he holds. So in the long run, I think the economy has a certain amount of productive potential and population to get us back on a decent level of global activity. But I think that the path from here to there, if we get rid of shadow banking in between, is going to be one that we're not going to enjoy very much.
I have two. Thanks for the questions. I have, I'm structuring my response in two. One to Jan's comment on the non-financial corporations. I think this is a key issue, and it relates to, the discussion we had during lunch. Actually, I read in the Financial Times. I think they described Apple as perhaps the world's biggest hedge fund. I mean, they're sitting on piles of cash that they have to manage, and I think this is just a reflection of the fact that I think in the U.S. you have something like $2 trillion in cash waiting to be invested, but at the same time being managed. I think the issue here is the following: in a situation where corporations don't or reject to invest, I mean, and we can discuss why they don't do that. I mean, ref again the discussion during lunch. Should you, in the meantime, have the government issue treasuries to satisfy their need for capital safety? Because they won't have their money in the bank because deposit insurance is limited. So, I mean, I think the proposal that Sultan Poser and some others have come with is that therefore the government should issue more treasuries to satisfy that need for capital safety. And also you could look at the shadow banking process as actually a process whereby, you know, financial loans were created in order to manufacture you know, products that could satisfy this need for either liquidity or capital safety. And I think that's a question mark because, you know, it's clearly then linked to the bigger issue and why did we get into a situation where corporations are sitting on cash instead of investing in real production? But I leave that at that. That's obviously a bigger issue. Regarding the question of what to do, I mean, clearly you've sensed my unease here between, you know, these two sort of forces. I've been around and I've worked in the central bank for 25 years, and my basic view is that we should help banks if they get in trouble. I think the dilemma is that when banks screw up so much on their own, I mean, it's really, I mean, they've made it hard for themselves, Ref Dodd-Frank, and as you say, you know, the limitation now is so severe that, you know, there is no way the Fed can actually replicate what they did during the crisis. And they probably should be able to do part of that in a new crisis. And that's, I agree. I mean, it may be that many are actually thinking that, you know, if you have a new crisis, they would just, you know, find ways of doing it. And that would show that the system is not as consistent as it were supposed to be. But I'm left with this question of how flexible we should be, and this goes back to the question of whether we should ban the whole thing and, you know, what would happen. Well, I don't know. I guess sort of it would be a pretty bumpy ride, but I think also there are so many regulations currently underway that it will be a bumpy ride anyway. And I actually forgot a slide where I included, you know, a discussion on the OTC regulation, which is coming on board. I mean, basically, for those not working in the area, OTC derivatives is an over-the-counter derivatives. Regulators want to get all this over on central clearing platforms, CCPs, and then you would have collateral requirement increasing dramatically, and both on CCP and not the least outside CCP. And somebody was saying we were entering a new ice age because, you know, this would, I mean, there is so much need for safe liquidity around it. You know, I mean, nobody knows what the aggregate amount of aggregate effect would be. And so, I mean, and then you have Basel liquidity requirements coming on top of that. So it's certainly going to be, you know, very interesting years ahead. I would say somehow that, you know, this is intentional. I mean, in a sense, central bankers, regulator are doing this in order to get price effects that would have volumes effects. Because, as somebody said on a conference in London, we want to get the volume down. So in a sense, you could say that, you know, the combined effect of this might be that you will get a much smaller sector, if not totally banning. But, I mean, it would certainly be less than what it is now. Whether it will then be a better system, I don't know, but I hope so. Certainly a more stable system, I hope.
Is this on? Is that working? So everyone's talked about this parallel, the non-financial banking system. I mean, I've taught banking for 20 years, and as have you. And so certainly I used to teach about the rise of finance companies and money market mutual funds and disintermediation and all that sort of thing. I don't think that shadow banking, that's all true, okay, and I don't think that shadow banking really came from there. I see it, at least right now, more as something that came from, as James just referred to, globalization, and globalization of funding markets in particular. So I see it much more as globalization of funding markets happened first, and we funded, and we had various crises there, like the Asian financial crisis, where Korean companies are basically borrowing in dollars, and the currency risk is being held by the central bank. All shadow banking is using that same funding source and using it to fund U.S. mortgage-backed securities. Okay, so it's using this mature funding source and extending it to a new sort of asset. A new sort of asset with new sorts of risks. It didn't have FX risk, okay, and so that everyone was excited about that. And in fact, it seemed like maybe it didn't have any risk hardly at all because people never default on their mortgages. And so we learned about that. Okay, so I see shadow banking as a global phenomenon from the beginning. Okay, that's the point, okay? And it's a global phenomenon because there's a lot of people who want dollar-denominated deposits outside the United States, and the banks need to find something to fund with that those dollar-denominated deposits. And that's still true. And so this story about the hollowing out of bank balance sheets, treasury bills all going to China, this is just part of that whole story. And I think maybe James has more to say about that than I do if we can coax him. The second point about accounting regimes. Yes, I am. I mean, we started the day with accounting, right? With Lance speaking about NEPA accounting. I think it's true that the accounting regimes we have to track this sort of system are quite inadequate. And that and they also prevent our understanding it as well. Just to give you a little example, the little balance sheets that I put up there in the first place, okay, you notice that I put credit default swaps and interest rate swaps and FX swaps as assets of one person and liability of the other. This is my convention. There is no convention about this. You know, these are usually just booked sort of as memo items, you know, at the bottom as off-balance sheet items or something. This is my convention to try to put everything in one place so that you can see the relationships. There's similar problems. People book repo in lots of different ways. In fact, the words aren't even the same. Okay, what people call repo in London is reverse repo in the U.S. So it's there. There is not consistency here, and a lot of this stuff is not being picked up in the statistical nets. Certainly not NEPA, but definitely even not the flow of funds accounts. And one of the main issues that's not being captured really very much at all is these collateral flows, okay, that are completely key. No one's sort of, you know, we're watching money flows. That's what Fed funds were supposed to be about. But you know, these collateral flows that he's speaking about are in the footnotes of corporate of balance sheets. Now we don't know that this is all of them. There's no it's just an attempt to kind of put this all together. So there is a serious lack of measurement, of knowing what this is all about. Now you asked about mark to market. I think I would emphasize that I do make as a characteristic of shadow banking that both the assets and the liabilities, there's a price there, okay, and so that you can mark them to market, and that's sort of what makes it special. Okay, that makes it different from other entities, and they in general do mark these things to market, or their counterparties do, you know, who are holding this stuff as collateral and so forth. So it's a pretty much of a mark-to-market world, okay, that we're talking about there, whether it's required or not. Okay, the legal business. So your third point, though, now gets me back to globalization. You say we seem to have constrained the central bank, but not the system. And is this new private safe money that James is calling for, is this really going to be possible if the law changes? I think, again, we need to remember that shadow banking is a global system. And so there is a kind of contradiction between shadow banking and our national system of regulation and of you know, contract enforcement and all that sort of thing. That it is there's a reason that, I mean, you can book these transactions anywhere in the world you want, okay, and they do. So London is favored for a while, and there's just really no reason why you can't move this around and do jurisdiction shopping, and you can book them where they're hidden, where you can't even see them. And so this is a serious challenge, okay, to the nation states, you know, claim to be the last arbiter of law, I think, and it's ongoing. I think globalization is either in our future or global depression is in our future. So this is a very serious issue.